Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to hit up Twitter, see what people are talking about. Obviously, I'm going to interject my financial opinions. It'll be related to commodities, financial um, markets, or anything that's wealth building. So let's dive in here. Let's see what's going on. And again, if you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. So we're going to start with this thread here. BHP and Rio Tinto are the world's largest miners. Together, they represent 250 billion in market cap. So recently, they shared outlooks in the Bank of America Global Metals, Mining, and Steel Conference in Barcelona. Here are your key takeaways for an investor. BHP views long-term fundamentals to be favorable. Global commodity demand to be supported by population growth, urbanization, rising living standards. And they project the economy to grow 2.5 times by 2050. They stress that a decarbonizing world amplifies the need for mining. It says, sorry, Elon, but more mining is needed. An estimate a growing demand for commodities, particularly for steel, copper, nickel, potash. They don't produce lithium. But here's the crux. So this is the large cumulative demand increases across commodities. BHP 1.5 degrees Celsius scenario. This is the planning range. We've got middle for crude steel. Copper, it's above where our planning range is. It's above for the planning range of nickel, and potash is above the planning range for potash. All the projects that are coming on. So some of these are going to be running deficits. Potash, nickel, and copper for these particular metals that we're looking at. Coming on down, it says the sector has been underinvested for over a decade. At some point, a reckoning is coming. Capital will need to flow. BHP puts the total required investment for copper at 250 billion by 2030. That's the same as the combined value of these two miners. So copper potentially needs around 250 billion of investment by 2030. Actual capex, really not that much compared to 250 billion. Committed capex between uncommitted capex was really what we need, and then 2022 to 30 total capex required up to 10 million TPA mine capacity addition needed post depletion and grade decline. And I know this seems kind of simple. Oh, we'll just put money into it. As these grades decline here, it's going to put an absorbent amount of pressure on energy because when the grades decline, the energy increases at an exponential clip. It's not linear. So the more mines that they put online that are new, and that's where all this money needs to go, this 250 billion to put a bunch of new projects online, it's going to put intense pressure on energy. So I think copper is just a derivative of energy. And these mining companies, all they do is use equipment and energy to get it out of the ground. That's all it is. But this is not news for them. They've been saying this for a while. They actually expect we'll need 2 times as much copper over the next 30 years compared to the previous 30 years. It says the world's going to need probably about 2 times as much copper over the next 30 years. That's crazy, guys. They know copper's hard to find. They have some of the largest mines in the world, including Escondida. Dad was part of the discovery team, and I visited as a kid. Major deposits are less common and are being found deeper and deeper. Deeper equals more expensive. More expensive equals more energy intensive. So this was released by BHP. Major copper discoveries are becoming less common and getting deeper. You can see how it hockey sticks and just falls off a cliff. That cliff falling off was started in 2000, and we're coming down, 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 down. And this isn't 30 years out over to 2050, but it looks like we are approaching very deep mineralization. So we've got that going on. Rio also sees a strong future. That's Rio Tinto. They expect total commodity demand growth to reach about 4% CAGR between 2022 and 2035, with equal growth in traditional and energy transition. including steel, aluminum, copper, lithium, nickel, and cobalt. They are not alone. Total commodity demand by 2035 in a less than 2 degrees Celsius scenario. Total demand growth, again, 4%, with a net uplift from traditional and energy transition broadly equal. This is your traditional demand of what they are projecting. And this here is your energy transition demand. So they broke out the two demands. If this doesn't happen over here, then this is still going to happen. And if you look, we've got a big copper, aluminum, and steel demand. And you can see what the energy transition demand could be on top of this. So that's cool that they broke that out. To put in perspective, JP Morgan sees this figure at 2.5%, I'll bet only for refined copper. Either way, this is big. Forecasted to grow by CAGR of 2.5% over the next decade is what JP Morgan sees. Also, Real sees both steel and copper at the core of decarbonization. And to put these figures into context for investors, here are the details for quantities used. Wind turbine, solar, and EVs. Each 1 megawatt wind turbine requires a lot of steel, a lot of copper, a lot of aluminum, and 200 kilograms of rare earths. Each megawatt solar panel requires a lot of steel, a lot of copper, and a lot of aluminum. And then each electric vehicle requires a lot of steel, copper, aluminum, and lithium carbonate equivalent. So coming on down, you'll find links to both these Rio and BHP presentations at the end of this thread if you like to read the fine print and dissect each assumption. That's it for today. Both BHP and Rio have leading roles in driving this unprecedented growth as demand expands. We'll likely see more investment mergers and acquisitions from these majors. Their dividend yields are still tasty at 9% and 6.25%. I do like those companies, though. I really do. Let's keep going. Ed Finley, Richard said, so 2023 does not equal 1980. So this is 10 years when oil demand declined. So these are the 10 years when oil demand actually declined. We had 2020, which was a forced shutdown. That's kind of an anomaly. That was the best buying opportunity of oil at the bottom here. Well, one of the best. 1980, down 4.3% in demand decline. 81, 2.9%. 82, minus 2.7%. So there's your big demand killers in 80, 81, and 82. And why is that? Well, that's when the housing market rolled over and the demographic basically declined. Then they jacked interest rates way up, and they had the combination of all of those things. So that is when demand declined. 2009, during that crash of 08, it went down 1.4%. 74, we had a housing market bust. This was a housing market. So housing market bust in 80, 81, housing market bust 2009, housing market bust 1974, housing market bust 2008, housing market bust 1975. So 08, 09 was a bust. 80, 81 was a bust. 08 and 09 were busts. These are all housing market busts. And why did the oil demand decline? Because we had a deleveraging in the market. That is why understanding the market conditions is what prices assets. And that's why the oil demand declined here. And we also have 83. So 80, 81, 82, and 83 were rough. And then we have 93. But this really isn't a huge demand destruction over here. These are definitely gigantic demand destruction events. So that's why 2023 does not equal 1980. We've got, you want to know a leading indicator I use as a recession warning? Here's a great one. Heavyweight truck sales have predicted every recession since 1973. A steep decline is an early warning that a recession is coming since 1973. A steep decline in an early warning of recession is coming. Right now, heavy truck sales continue to increase. And then the question is, well, why are heavy truck sales continuing to increase? Well, probably because you've got a housing market boom that's still ahead of us. And in order to create those homes, you have to have big trucks. You carry lumber around, you have concrete, you have other construction things that are being constructed. We also have construction going on in manufacturing. And we need equipment in order to do that. So this is heavyweight trucks, and you can see the decline before all these dark recession lines. So yeah, it could be a very good indicator. This is more or less, if you were to combine a couple leading indicators like perhaps heavyweight trucks, construction employment, housing starts, and maybe total bank credit, you're going to get a pretty good picture of what if a recession is coming. A lot of those leading indicators are not turning down, which makes me think that either a recession we could just have a slowdown or a small recession if we do have one, but the major indicators are not, they haven't rolled over yet. And that's, construction employment, heavyweight trucks, housing starts they've come down a little bit, but they're still above average. So I don't think the recession is in the bag here. Like a big crash recession, like a big move to the downside. We can still have a slowdown, no doubt, and we could still have a recession. I just don't know if it's going to be a big one, like some of these people claim that it's going to be, because we don't have any of the leading indicators really rolling over. So coming on back, Justin, your followers might want to also see this chart here. It's talking to Uranium Insider. So this is the VanEck Uranium Nuclear Energy ETF. Things that go boom. 3-year moving average squeezing price upwards. So here's your moving average coming. This is your downward move, your basing, and then you've got a breakout. And this here, generally speaking, is the best time to buy an asset because you've broken the base and you're starting a new uptrend. So uranium is starting that new uptrend. It looks like we're breaking out, continuation breakout to the upside here, this past quarterly log chart. So on a big picture view, everything looks pretty wonderful for uranium and the equities here. And you also have SWU moving higher. You've got U308 moving higher. Guys, this is something. I mean, I'm already positioned. I bought, somewhere in this range over here when this started coming back up because it was just incredibly cheap from a ratio perspective, and everything's looked good the entire time. And I know people get frustrated; they get grinded down by the sideways motion. But guys, you got to change yourself if you want to make money in these markets. You need to become a student of the market. You need to change your time frames and your expectations to when the market moves and the time that the market moves. We are at the mercy of the markets. We don't determine prices, and right now we're just starting an uptrend. So I know a lot of people, they become impatient with it, but I think uranium looks absolutely excellent. So what am I going to do? I'm not going to do anything. I'm going to hold on and just ride this sucker. I've already got my allocations, and if more money, like if it pulls back a little bit, maybe I'll add a little bit more in. But I think it looks good. I think it looks great. In fact, it says renting is all fun and games until you've been living somewhere for 5 years, and the landlord decides to kick you out so they can move in or sell it. So that's what happened to me. I was renting a 2-bedroom condo. We were getting pretty big. The family's getting too big for that, and the owner, she told us like 2 months before she was going to sell it. She's like, I need to get out of here 2 months. I'm like, oh my God, that is like really tight. So yeah, I was looking for a house for a good 6 months, 8 months before that. And that really put the hammer down, dropped the hammer. I hate that feeling. I hate that feeling where I've got a tight deadline and I really got to move quickly. So I don't want to be in that situation again. I would much rather own than rent. And I know a lot of people on Twitter and YouTube, they talk about how renting is better than buying. And maybe that is the case at this particular time. I don't think so. Renting, the problem with renting is you're taking one of your largest expenses and you're basically letting it float. So your largest expense is floating around, and it generally floats higher. What I did is, when you buy a house, you lock it in for 30 years and you fix that largest one of the largest expenses that you have. And when you fix it in place, and if you have inflation in the system, you're fixing something that's a large expense and you're letting inflation eat it away. Rent, it doesn't do that, and you're exposed to very large rent increases, especially, I think, especially since we've got a large demographic that is coming through. Rent could continue higher, and that's where I'm like, I mean, if I was renting, guys, I would be paying so much more money for rent, renting the same house that I'm in. I mean, it's ridiculous. I'd be paying at least 3 times or more for versus what I'm paying for a mortgage, and what I'm paying for rent. And I understand that insurance is in there and property taxes, but the property taxes here are cheap in Colorado, and the insurance is I mean, it's cheap too. My insurance actually costs more than my property taxes do. So we go to Logan. He says the value of your fixed housing payment, the hedge against inflation, has yet to get the love it deserves. And I completely agree. And I think these two are interconnected. I put them next to each other when I saw them. So yeah, your the value of your fixed housing payment. You take one of your largest expenses and fix it and hedge it against inflation. That's exactly what I did. Um, if you want to make as much money as possible, you want to look at your expenses. You want to fix your expenses if you can, or eliminate or reduce those expenses. I don't have a car payment. I haven't had a car payment for over 10 years. I have the same car I purchased. I purchased it in cash in 2005. I haven't had a car payment the entire time. I bought a couple of other cars, which were not very expensive cars. All the cars I own, if you were to add up all my original purchase prices, I bought a car for 1,200, 12 grand, and for $7,500. So let's just say it's $21,000 is all of the car purchases I've done in my life from 2005. I spent $22,000. I've probably spent as much in insurance, insuring the cars, than I have in actually buying the cars themselves. And obviously that's not my total costs. There's more costs in maintenance and stuff like that. So, I mean, maybe I've spent 30 grand in total or something like that, for all of my car expenses. That is what my car expenses look like. And I am a car guy. Some people say, oh, you're not a car guy. Guys, I'm the biggest car guy there is. I go track cars at the track. I go run autocross. I run the cars hard, and I maintain everything myself. I go through a lot of wear items like brake pads and rotors, but you can buy those for pretty cheap if it's a Japanese car and stuff. I own an RX-7, an RX-8, and I own a cheap commuter car, Chevrolet Aveo, and I run them, guys. I run them. It's a lot of fun. But just because I don't go out and buy a Porsche, whatever it is, doesn't mean I'm not a car guy. My RX-7, it holds its own. And the RX-8, when I'm on track, I run about the same times as a lot of these other sports cars. And if I really wanted to push it, I could get, Hoosier slicks, run some really wide tires, and it would be just as fast as a lot of very fast cars. So yeah, that's a huge deal there. It says you'll be 10 times more profitable if you stop adding to losing positions and start adding to winning positions. Start watering your flowers, not your weeds. The way that I say it is add into strength, don't add into weakness. There could be times where things pull back and you're buying a basing bottom, where you're going to be continuing to cost average in, and you're not necessarily adding to losers. What you want to do is you want to find technical chart patterns, big ones, that are going to net you gigantic upside returns, and buy the base. Buy the base or buy the breakout of the base. That's what this was here. You're buying the breakout of the base. I bought the base over here. You don't want to be buying if it's coming into a downtrend like that. So right now, if I were to add companies into this, losing companies or companies that are really highly valued, I'd be very careful of technology companies. They don't do well under a rising interest rate environment, and someone could argue that interest rates aren't going to go up; they're going to go sideways. But I think they're highly susceptible to a downturn, and they're valued incredibly expensive. It's not a winning formulation. A winning formulation is when something is incredibly cheap, like commodities. You might have a cyclical pullback here, where they could go down, and then when it comes back, the money comes into the system. Interest rates, I don't know if they'll normalize or whatever. I think it's going to continue to push commodities higher because that's where the problems are at, and they're cheap. It's a combination of those two things. Shift in major homebuilder stocks this decade so far. So D.R. Horton, Leonard, Toll Brothers, Pulte Group, NVR, KB Home, they're all rocketing higher here in 2023. Question is why? Why are homebuilder stocks rocketing? Is it because we're in a housing bubble and that we have too many homes and we're in a hyper supply phase? No, it's because we don't have any homes. And right now, since the inventory of existing homes is low, you have to build all the homes that these new buyers want. That is part of the cycle. That's where you enter the big expansionary phase of real estate. Looks like the market is understanding that, and they are bidding up the homebuilder stocks. So yeah, I agree with that. Silver is right up against the blue massive floodgate. Note that the chart already has a clearly defined false breakout, so the big picture down move for creating needed volatility before breakout is already done. So here's that false breakout. We came up and we're just hitting against resistance on a quarterly basis for silver, and we could bust out of this thing at any point. So silver looking good. This guy says if you put $77.50 per year in an HSA, that's a health savings account, the max for a family in 2023, and invest in good index funds, it will be worth $132,000 in 10 years, $490,000 in 20, $1.5 million in 30 years. Better yet, it's all tax free. Are you using your HSA Advantage? So you use pre-tax money to put it into the account, and you can take it out tax free. I actually maximize my HSA every single year, and if I hit health expenses, I just leave that money in there, and I actually pay it with after-tax money. I'm actually using this as a retirement account and going for it with that account. I'm putting as much as I can. I put the $77.50 in there per year, and I just let that baby ride. So yeah, that is one of the best accounts you can use to make money in. You can take it out. It's supposed to be used for health expenses, but it can turn into whatever you want it to be towards the end when you're in retirement if you don't have health expenses. So that's going to be one of the tax-free areas that I'm going to have a big advantage in. Eric Nuttall says the discount on Canadian heavy oil is now down to $11 a barrel, the lowest in a year. We remain bullish, especially on Canadian heavy oil producers with 30 plus years of reserves, rock solid balance sheets, record free cash flow, and the commitment to return 75 to 100% of it back to us in the coming quarters. And there it is coming on up, that discount. I agree. I actually totally agree with him. I think the risk over in Canadian oil companies, just in oil companies in general, is super low, and you're paying very little for it. And they're in a really good position to pay out a lot of dividends and share buybacks right now to the shareholders. It says, don't underestimate residential real estate. These counties just chewed up the biggest mortgage rate shock since 1981 and spit it out. This is a map showing the US counties back to their pandemic home price peak. In other words, these counties just set an all-time high in April of 2023. This map will be bluer once the May data drops. These are all setting highs in here. So the West is kind of getting their butt kicked in because nobody wants to live there. And they're all migrating towards the middle of America. So that's what we've got there. And that's where I'll end it. So that's what we've got for today, guys. If you guys like the content, don't forget to give a thumb up, subscribe to the channel, subscribe to the website if you guys like. And that's all I've got for today. We'll catch you later. This is Finding Value.